Hello, everyone, and welcome to our July 2022 Cryptocurrency and Equities Collision course, where we at Seven Investing team up with our partners at CryptoEQ to talk about the collisions between equities and cryptocurrencies. I'm Seven Investing founder and CEO Simon Erickson, joined by my colleague Steve Symington, who is Seven Investing lead advisor, and also Spence Randall, who's one of the principals and co-founders of CryptoEQ. Spence, how are you doing this morning? How's things going here in Houston?
It is hot. I'm melting over here.
113 heat index for us over the weekend. Steve, I assume that's not the same for you up in Montana right now. At least I hope not.
We're like 80 degrees. It's perfect. I couldn't do 113. That's absurd.
Oh, well, things are heating up, certainly in the cryptocurrency markets as well. We got a lot to chat about like we always do, so we're going to jump right in just to set some signposts for the conversation. There, we're going to be talking about the classic CeFi versus DeFi debate. We're going to talk about Jack Dorsey in a minute. We're going to talk about some announcements from Seven Investing and CryptoEQ, but let's start on the topic of unsustainable yield. Just to frame this a little bit before we get too into the nitty-gritty, cryptocurrency exchanges kind of started rather simplistic, right? It was a way to buy and sell Bitcoin. The larger exchanges like Coinbase would take a small stake for any time their transaction was made. But over time, we realized that as assets were migrating to these platforms, there was other ways that they could make money. And the crypto economy, as it was becoming known, was able to pay people with the assets in more and more ways. It was similar to if you gave money to your bank, they could use it for other loans, which are higher value activities for them. The same thing was true for crypto exchanges. There was ways to use staking, where you could actually use your cryptocurrency assets for proof of stake, proving out the transactions that were on the network, and you could get paid for this through commissions. There were other ways where you could actually have the exchange borrow your cryptocurrencies and pay you 6 to 10% APR interest rates, or they could be used for collateral for loans. But Spence, I've got to start with you on this one. It seems like some of these more exotic ways that exchanges or cryptocurrencies or DeFi protocols are using cryptocurrencies, some of them are great, some of them are very credible, but some of them seem to be running into problems. Recently, we've seen some, there's a new DeFi protocol called Olympus, I believe it is, with OHM as a cryptocurrency that was offering up to 500% annual percentage rates for people that were actually participating in its network. Stuff like that seems like it might be a red flag to me, but what's your take on what's going on out there in terms of what's sustainable versus unsustainable in some of the ways that these cryptocurrencies are being used right now?
Yeah, I can say a lot here. The first thing I'll say is kind of to point out patterns in how crypto protocols and crypto projects are allocating their spend. So developers are incentivized by a lot of times marketing incentives, and adoption is incentivized a lot of times by marketing incentives. And some of the most successful projects in terms of gaining adoption did so by subsidizing yield. And it's not a surprise that double the market rate for yield is very attractive to crypto early adopters. So the best example of this is Terra, the Terra ecosystem, which has since imploded. But our early research identified that the yield that the Anchor protocol was offering, which is part of the Terra ecosystem, was completely unsustainable. And to give you a little bit under the hood kind of perspective, and when you peel the curtain, when you pull the curtain back, you look at what was actually happening. As part of their marketing incentive, they were allocating capital to basically double the market rate for yield on a specific asset. And that worked okay. It worked great for adoption. It worked okay as a functioning crypto economy when the value of the collateral was appreciating. Now, when we experienced this sustained healthy downtrend in crypto and the exuberance washed out and things got much more rational, they were no longer able to sustain that rate of yield, and the dominoes started to fall and the whole ecosystem imploded. It's the largest destruction of capital in crypto that I've ever seen personally. I've been watching the space every day for 5 years. So a historic event, an important event, a sensational event, and a big lesson for the community to learn from. But that's an example of unsustainable yield and its impact on the crypto economy. One other thing I'll say is for any folks that are part of the crypto ecosystem, projects like AAVE, which are a decentralized finance protocol that offers lending and borrowing opportunities in a decentralized manner, is a really great way to get a temperature check on some of the yield that's being offered at some of the service providers that you're using. So if you ever have any questions about whether or not yield is rational that's coming from a service provider or a protocol or a project, AAVE is a great benchmark to look at. Is this rational? Is this reasonable? Is this real? Because that's truly an open, decentralized marketplace where borrowers and lenders in real time are autonomously defining rates.
Spence, you have called AAVE a cryptocurrency blue chip. It seems like this is the bellwether. This is like you said, it's the temperature check. It seems like if things are out of touch with reality, that could lead to problems. But this is kind of a barometer that you use for what's reasonable in the marketplace out there.
Yes, AAVE has taken a significant market share of DeFi. It's emerged as the best lending and borrowing platform in DeFi. Another name I'd add to that mix is Curve Finance, token CRV. AAVE's token is AAVE. But both of those projects are doing great things for DeFi, and I would encourage the audience to read more about it. We have a report out on AAVE at cryptoeq.io for anybody that would like to read more free research on this DeFi blue chip.
Yeah, it's funny because how often do we have significant market events like this that tend to materialize, and then we see sage advice from legendary investors like Warren Buffett come back into play, right? And the thing that keeps echoing in my mind, when we talk about kind of collapses like Terra, is when Buffett said, only when the tide goes out do you discover who's been swimming naked, right? And it's hard to judge, who's truly successful in a bull market. It goes for investors as well, people investing on margin, on the topic of unsustainable yields. So it's funny, it holds true across multiple markets, crypto, equities, whatever we're looking at. So it's been interesting to watch, kind of this drawdown, not only in crypto, but also on the equity side. We just endured the worst first half start in any year since 1970, and the biggest drawdown in growth in tech stocks since the dot-com bubble, and that it's all happening in tandem. Part of me wonders, how much of this is an expectation of a drawdown in liquidity, a combination of all that, tighter, monetary conditions. I think it's something important to note, though, from an investor's perspective, that that doesn't mean markets overall are broken. I think it also means that markets are working efficiently, and we're now seeing kind of how some businesses have, we're doing things in an unsustainable way, and that hurts when you make that bet, and you're someone like, you're running something like Terra, and it implodes as a result. But
I'd like to speak more to Terra, and what made it special is there's been a lot of things in crypto that's convinced retail in mass to enter and allocate unsustainably, irrationally, too much exuberance, a lot of things like that have collapsed, rightfully so. What was interesting about Terra is the amount of institutional capital and professional investors that were rallying around this vision for the project, and then to fail so publicly and catastrophically and destroy that much capital. It was the first domino in a series of things that have happened, flushing out a lot of irresponsible, to put it nicely, risk that was in the crypto leverage system.
So maybe we emerge from this a stronger system, right?
Absolutely.
Let's talk a little bit more about that one, Spence. We wanted to talk again. We talked with your colleague Raven Moore last month about the CeFi versus DeFi debate, centralized versus decentralized finance. Can you explain, first of all, what that even means for people that aren't familiar with those terms, and why this might be an opportunity to flush out some of those toxic assets, or to put it bluntly, some of the problematic things that were going on in crypto before this drawdown?
For the 7 investing audience, the easiest first step from your equity brokerage accounts to the crypto sphere is CeFi. It stands for centralized finance, and it feels more like your crypto brokerage account, where there's some third-party company that helps you gain exposure to what you'd like to invest in. And a lot of these companies will help you with your fiat, cash on and off ramps. And the most reputable will allow you to withdraw and deposit crypto directly on the platform. So that's if you're comfortable and want another company standing between you and your assets, then that's what CeFi is for. DeFi is, in my opinion, still further out on the risk curve, because you remove that third-party company, that service provider, which you ultimately do trust, from the equation, and it's really you, a network that's distributed and in most cases decentralized. No, in some cases decentralized, like AAVE, and then peers. And all of these markets are made peer-to-peer. And instead of trusting a third-party service provider, you're trusting a network like AAVE to make these markets, these lending and borrowing markets. And so that's the extra step that you're making. If you're looking at, say, an exchange instead of a lending and borrowing market like AAVE, then you're looking at a DEX, which is a decentralized exchange. You could think of it like your decentralized brokerage account. DEXs, things like AAVE, that's DeFi, and then CeFi would be more like Binance, Coinbase, Gemini, Kraken, Nexo, your leading names in the crypto sphere.
And are we seeing a breakdown of some of those CeFi names? I mean, some of those have had kind of either regulatory, they're right in the crosshairs of regulators, or some of them have been hacked into and lost assets. I mean, what's your take on CeFi versus DeFi? Is one of these models superior?
Well, the big theme, if you look at a 10,000-foot view, is companies and projects with strong balance sheet and proper risk management are still very strong in this market. And that applies to CeFi and DeFi. And when I say company in the DeFi context, you'd have to mean a well-managed treasury, a well-managed DAO. Now, on the DeFi and CeFi side, you have companies and projects that did not manage risk well, or did not audit their code to the extent that they should have, and those went belly up. So on the CeFi side, the best example would be Voyager filing for bankruptcy. The biggest domino leading to that would likely have been the exposure to Three Arrows Capital, which is a crypto hedge fund that also is filing for bankruptcy. So you can see contagion that can be traced back to the Terra collapse, still working its way through the crypto ecosystem. So the short answer is there's great projects and companies in CeFi and DeFi that have proven to be resilient. And then the fun thing to think about is the CEO of the largest exchange in the world, CZ, and Binance, the largest crypto exchange in the world, said that DeFi will be the standard in 10 years. So that's very interesting that someone that has built the largest centralized exchange for crypto in the world holds the view that CeFi will go by the wayside over time. He has everything to lose if their company doesn't continue to embrace DeFi as they have been. They've been very progressive. But it's not a short answer, but hopefully that made sense.
It's complex. It's Steve. I mean, it's similar to what we've seen with the equity brokerages, right? Like a model like a Fidelity that's got, you know, assets under management, and you've got funds you can turn to. It's not just an exchange where you're buying and selling. It's been kind of like the skyscrapers get larger and larger when the brokerages charge lower and lower. And any other thoughts on kind of what Spence was saying about how that might not be the same path that crypto takes, though?
It's funny how you have a leader of a CeFi platform making the prediction that DeFi is the future. And it reminds me a lot of Jamie Dimon over at JP Morgan in his most recent annual letter to investors, just a few weeks ago, I think, or maybe a month and a half ago. Where did the time go, right? He was talking about how neobanks and a lot of fintechs, up and coming fintech companies are probably the greatest threat to today's existing banking, legacy banking titans. And he's talked about how they're taking market share, and in kind of a hybrid bank is really what they have their eyes on. So, I mean, also that's the sign of a good leader that they can recognize those threats and position their own businesses accordingly. Doesn't mean I want to go buy shares of JP Morgan. I'm more interested in a couple of the up and coming fintechs, and, you know, including some that have actually become national banks themselves, like SoFi, for example. But it's interesting to watch the parallels of the leaders in both sides of crypto and equity, kind of calling out what is the future and positioning themselves accordingly. And I think that's encouraging, really, because they're realists, right? You know, when they look and understand the dynamics of their own marketplaces. And perhaps the worst thing you could see is a leader in one of these spaces ignoring or underplaying the threats that they're facing, and well, getting disrupted, right? That's the standard innovator's dilemma. If we're
now
looking
we're talking,
at
Steve,
the yellow book right here on the shelf, right? And so it's encouraging to watch, I guess. So
it's also, I mean, something to keep in mind at the end of the day too, is like with all these stories, right? Like you mentioned some of them in kind of our pre-discussion brief here, Spence, of like 3AC is filing for Chapter 15 bankruptcy in New York. Voyager is filing for Chapter 11 bankruptcy. FTX and BlockFi are reaching a deal for FTX to acquire BlockFi assets right now. There's more and more acquisitions. There's a lot of M&A going on. There's a lot of bankruptcies going on. At the end of the day, I mean, there are still users and assets in play here, right? These are still platforms that people have taken the time to sign up for, create accounts for. You know, now maybe they get kind of put into a different platform that buys them, or it goes bankrupt. They have to find something else out. I mean, this is when we talk about things like switching costs with banks or network effects with platforms. These are in play. You know, when you've got assets and you want exposure to these things, I think trust is coming a large part of this more and more. And you're starting to see the good news stories separated from the bad ones, and seeing, like you said, Spence, the trends of what works and what doesn't work. But at the end of the day, there's still a lot of money that's out there. There's still a lot of users that are interested in crypto. This is going to be a storyline that plays out for quite a while, I think.
Yeah, there's hundreds of millions of users up for grabs, and billions of dollars of assets, some of which are distressed, up for grabs. And this M&A activity, I anticipate to take 12 to 18 months to transpire. But the kind of patterns in what I'm reading and watching and what our team's looking at is FTX is posturing with strength. Binance is posturing with strength. Nexo is posturing with strength. And then a lot of what we could call secondary players, some which were primary players at one point in time, are getting acquired or merging.
Steve, we're seeing the same thing in the equity world, right? And we've got rising interest rates, which are making capital harder for smaller companies, especially if they were saddled with debt. They're not growing as quickly as they were. I mean, those that raised money last year, either at low interest rates or maybe used equity or did SPAC financing or whatever it might have been, have got a strong balance sheet now. They're in, like Spencer just said, you know, a position of strength to go out and make some moves, M&A included.
Yeah, and that's you know, you kind of called that out several months ago, and you said this is going to be, it's like going to be a harder market to raise cash, and a harder environment, and if you don't already have it, you know, especially companies in in cash intensive industries that require kind of establishing early industry leadership, the space economy, for example. A lot of these rocket ship companies and launch service providers need a lot of cash. And if they weren't able to raise it, they're probably going to get acquired or go bankrupt. And we've seen a lot of kind of heightened M&A activity just kind of across the board. There was a healthcare company just the other day on our scorecard that popped because there was some reported M&A interest in the company, and then a couple of my recommendations, and I think one of Matt was like, this is devastating if true, and one of his recommendations just last week. There's 3 different companies in the last week and a half on our scorecard that are looking at getting bought out reportedly, because in part their stocks have been thrashed in the growth stock pullback. And not that these businesses aren't otherwise solid businesses, but I think not only are we seeing M&A activity because of distressed assets or businesses that are having a hard time staying afloat, but also we're seeing M&A activity simply because valuations have compressed so deeply, and that we have larger industry players with the cash to spare that are looking at potentially making a move while they still can. And if you have an up and coming competitor whose stock has been absolutely thrashed, and it was a $20 billion business, and now it's a $4 billion business, according to the market, why not try and make a play for it while it's still cheap? So, in an ideal world, with a couple of exceptions, I would prefer to see, the growth stories of these businesses play out if they're otherwise healthy businesses. But I think we're going to see a lot of M&A in the next, several months, unless the market rebounds in a big way. So yeah, a little heartbreaking for an investor who would rather let these growth stories play out, but that's just how it goes sometimes.
I think so, Steve, especially in software as a service. We saw the valuations for those possibly a little overvalued in 2021, have come down to 10 times sales or less for a lot of those companies. Yeah. I've seen a lot of private equity shops trying to raise capital wherever they get it from right now, because they want to take a lot of those private. Certainly heartbreaking, like you said, if you like the long-term growth story, but it is something worth paying attention to. You mentioned that several of the companies on our scorecard are even M&A candidates right now for being acquired.
Yeah.
You also mentioned the space economy is kind of a higher capital intensive industry, that we've got some companies that are protected. If you do want to see the 7 investing scorecard, or even better, our favorite ideas from the 7 investing scorecard, we just did something really fun last Thursday. We announced on July 7th, 2022, that we're going to be introducing the Strong Buy portfolio. We've come up with our 20 favorite positions from all of our 7 investing recommendations. We launched in March of 2020, and so here we are in the summer of 2022. We've got almost 200 reports that we've issued since we launched in those 2.5 years, and we've said, okay, out of all these companies that we picked, what are our 20 favorite ideas right now? And so we're giving that away for free for any subscribers. You can also come take a look at it if you'd like. I'll put the link to follow along. We're revealing 3 of the 20 companies away for free. If you do want to follow along with that, the 7 investing strong buy portfolio. Steve's got some picks in there. I've got some picks in there. In fact, all of our lead advisors coming up with our highest conviction ideas. 7investing.com, if you'd like to check out our site. Spence, I know that you also at cryptoeq.io have had some recent product announcements that are pretty exciting. You want to take just a minute to talk about those really quickly? It'd be great.
Yeah. We've been, our motto is always be launching. So we've been launching in perpetuity since we started our partnership with 7 Investing. Some of the things that, I'm personally really, really excited about. We launched an audio feature. So I'm a big podcast consumer, and a lot of the content I digest will be auditory and visual. So I can, multitask and run and gun. So I can now, and anyone in the audience can now listen to all of our research, all of our core reports. I think a nice analog would be the 7 investing research that you do on the fundamentals of equities. We do that for cryptocurrencies like Bitcoin and Ethereum. So the deep research that we do on the crypto side helps us identify what is undervalued right now relative to the fair market value of things like Bitcoin and Ethereum. And so we have our own system at CryptoEQ that helps identify both value and growth investments. And we've been doing that for years as well. So the audio feature is something that I'm jazzed about. Something else that we've just launched is our API. So we've actually got other crypto businesses tapping into our systems and information via licensing and an API. Well, you'll see more developments in the future on that, but we'll be announcing a partnership here very soon with the first company that is using our API. So that's manifesting that Morningstar of Crypto nickname that a podcaster gave us years ago. We are opening up our information and systems to API access.
Absolutely. Well, in addition to doing some great research, we kind of enjoy this conversation every month where we talk about, where are these two colliding? I think one person that is part of the collision between crypto and equities, at least in recent years, has been Jack Dorsey. Right? Jack Dorsey, of course, such a fascinating individual. Everything that he had built with Twitter, kind of in the news lately. We've seen Jack step away from Twitter's board of directors here a couple of months ago. Twitter is in the process of being acquired, maybe, by Elon Musk right now. And so that's an entirely separate plot line. But we've seen Jack Dorsey kind of doubling down on cryptocurrencies, specifically on Bitcoin. He is building some incredible things with the company formerly known as Square. He's now renamed it Block. And this is something that started as kind of a way for merchants to accept payments, directly from credit cards. If you just had a smartphone, you always remember the little dongle that Square made so popular for merchants. Then kind of expanded into peer-to-peer payments. The Cash App was a great way to transfer money to your friends or to other merchants very quickly. On top of that, Jack really started getting involved with cryptocurrencies. He wanted to make Cash App a way where you could actually buy and sell crypto, and he's incorporated that into it as well. Steve, we saw that Block went out and acquired Afterpay, right? So now he's interested in the installment plans and the buy now, pay later plans. That was almost a $30 billion acquisition, if you can believe it, showing how all in he is on something like this. And then just not too long ago, we also saw him buy Tidal, something that was connected with Jay-Z and others for NFTs for musicians, because he saw a lot of similarities between musicians and small businesses in terms of raising capital or for projects or for recording and things like this. Spence, let me start it with you. I would love to know your opinions of Jack Dorsey as an evangelist of cryptocurrency, specifically of Bitcoin. Is he moving the bar out there? Is he a visionary that's got all these great ideas, or is he kind of a step behind a lot of the other stuff that we've chatted about here right now? What is the insider's take on Jack Dorsey from someone who follows crypto?
Sure. Before I followed Jack and his interest in crypto, I listened to a lot of interviews. I like to listen to interviews with founders and hear about how they think about the world. And I got to know Jack through content as someone that is a builder and a hacker. And I mean that in a good way. Like, he likes to find the smartest way to build. And he seems to really get a lot of fulfillment out of building. And I can't think of an industry that needs more to be built than crypto. And so for someone that loves to build and grow organizations and culture, that this is a great space for him. Now, why Bitcoin is a great question. So he's known as a leader in the Bitcoin community, and he focuses on Bitcoin. And one of the reasons why that might be is if you're going to invest 10 years of your life in an ecosystem, you'd want it to be in something that's here to stay. And Bitcoin is the most de-risked cryptocurrency in existence. And so if you're creating legacy and you're building for a lifetime, it's a great space to be a part of. Now, specifically, his vision is to help scale the Bitcoin network. And this is not just limited to Bitcoin. All cryptocurrency ecosystems have to think about scale and have challenges with scaling. Ethereum and the list goes on are all wrestling with the challenge of scaling. And so within Bitcoin specifically, you've got a fantastically secure and great base layer in the Bitcoin network. But if you want billions of people to transact atop the Bitcoin network, the question of scale is screaming at you, right? And so a lot of what Jack talks about and focuses on is scaling Bitcoin through things like the Lightning Network. An analog to that would be there's other ecosystems like Ethereum that have their whole, you could get a PhD in Ethereum's ecosystem. There's so much detail there, but Ethereum has its means and mechanisms of scaling, and Bitcoin has its means and mechanisms of scaling. And Jack thinks that a lot of DeFi can happen atop the Bitcoin network. So a lot of the things that we talked about earlier in the podcast about AAVE, Ethereum, and the list goes on, Curve, he thinks that a lot of decentralized finance can and should happen atop the Bitcoin network. So I think that, when he wakes up in the morning, that's what he's fired up about, is bringing more of DeFi to the safest and most secure network in existence in Bitcoin.
Yeah, Dorsey is he's an interesting fellow, right? One of the big kind of takeaways, and I'm sure this will dominate, continue to dominate headlines for a long time, is that he talks about Block, formerly the artist formerly known as Square, right? We can say, given their acquisition of title.
With the symbol too, Steve. We got to get a symbol for it.
Yeah. The block symbol. Yeah, that was different, but it's an interesting vision, and I think one of the headlines we'll see dominate for a while is him likening them to people's early descriptions of Amazon as a bookseller. He's like, you can't call Square a payments company. It's like calling Amazon a bookseller, and Amazon does a lot more, obviously. And look at Block stock. Square SQ is the ticker. It's down 75% over the last year, 60% so far in 2022. And they've got a lot of irons in the fire, and they're renaming the company to revolve around their focus on blockchain and crypto. And yeah, he focuses, I think Spencer mentioned earlier, really on Bitcoin as kind of their primary lever, as sort of the cryptocurrency that kind of revolves around the internet, and he doesn't focus too much. What was crypto at last glance as a percentage of the gross profits? It's like 5%.
Very small, yeah. Cash
something like that.
Less than 10.
Right.
Yep.
So you wonder how much this pullback is because of their involvement, but maybe not necessarily deserved for the company. I mean, they've got a thriving ecosystem, a growing user base, gradually expanding profits. Really interesting to watch. I think it'll be really interesting to watch what happens to them over the next 5 years, because a lot of what he talked about was at their last investor day, and he hadn't held one for 5 years, but a lot happens in half a decade in these kind of markets. So I think he'll be a trailblazer in this space, and one of those rare cases that crosses over between both crypto and equity, right? In the public markets.
It's kind of interesting too, Steve, of like founders that can do what they want to and no one can tell them no anymore, right? Like we're done with the days of Steve Jobs and Apple, where they needed to bring in an external CEO to take the reins because venture capital demanded it. So, same thing kind of that Alphabet and Google went through too, when they brought in Eric Schmidt to kind of, steer the ship for a little while. Now you've got the Jack Dorsey still in the captain's seat, still at the helm, and everything that he's created at Square and now Block. Mark Zuckerberg, I would put him in a similar boat that, refused money early on. And now just the transition, thinking of something like what Facebook was as a collegiate network where people were making friends. And now he wants to go all in on the metaverse. He wants there to be billions of users across the whole world using virtual reality and this entirely new way, which is still a fraction, just a very small fraction of what Facebook's revenue is today. It's still primarily targeted advertising. It seems similar with Jack Dorsey and what he's wanting to do. Like you just mentioned, Block is not a payments company, just like calling Amazon a bookseller. He has some big ambitions with crypto right now that are still less than 10% of the contribution of where they're actually making their money from. It'll be really interesting, in my opinion, seeing what an evangelist he is for cryptocurrencies and everything that he's wanting to. He was even trying to push Twitter in this direction too, and now he's not calling the shots for Twitter quite as much. But I do think it's going to be really interesting to see where Block goes in the future. Spence, any final thoughts on Jack or on Block, or where he's kind of steering the ship right now?
Like a general statement on the technology that's being developed, whether it's Bitcoin or AAVE or this list goes on. There's a lot of great, interesting things happening in crypto. The technology a lot of times is the back end, and then as users, we use apps every day, web apps, and it's all about the user experience and the interface. And the front end can stay the same, and the back end can change completely. And whether Dorsey's successful in his vision, whether AAVE is successful in their vision in the long term, the back end of what we're doing can change, and we can just continue with the behaviors that we have when interacting with our personal finances or our company finances. And a lot of folks, it won't matter to them the how, so long as they can. And I think that insofar as Bitcoin and crypto and these other innovations in fintech are happening, and it's it's increasing margins, and it makes sense from the business side of things, and the user experience is great, that we'll continue to move in this direction. And that's happening in the Bitcoin ecosystem. It's happening in DeFi. We're hearing banks signal this. It's the writing's more than on the wall. And then the markets are down. Things are a little more quiet. It's a great time to do fundamental research into the equities and the cryptos that you think are going to change the world. And that's why we're here to help.
Absolutely. And Steve, one more thing maybe I should call some attention to. While we are talking about leadership and the vision of these billionaire entrepreneurs, and there's quite a few of them out there right now, is to really go behind the curtain and look at the proxy statement and look at stock-based compensation and more broadly the compensation plan of how a lot of these companies are paying their executives. When you do have either a majority control or a large percentage of a company's voting control in the hand of a few individuals, they oftentimes have their vision. They want to do things their way, and they have what they want the company and its resources to be used to accomplish that. Sometimes that's not always to the benefit of public shareholders such as ourselves. Twitter has suffered from excessive stock-based compensation for many years. Yeah. I could rattle off several other companies that are having similar problems. And with stock prices hitting the low point of the cycle here, that can create a lot of problems for some tech companies. I know that's something you and I chat a lot about. We talk about incentives and stock-based comp and even capital allocation.
Right. Yeah, and that all speaks to dilution for existing shareholders. There's a couple of those companies, that have talked about as it's become more important. They to investors anyway. We've seen kind of the topic of dilution, stock-based compensation, get a lot more airtime in quarterly earnings calls, and these companies said, "Hey, it's okay. We'll keep dilution under 2%." And yeah, so because it wasn't that big of a deal, when you're giving away shares that are just appreciating, nobody cared as much how much they're being diluted as long as share prices were soaring. And now it's a little different. People are a little more selective about what they're willing to accept from executive teams. So,
Spence, is there any analog to this in cryptocurrency world? Steve and I talk a lot about executive compensation, stock-based compensation, capital allocation, and how they're using the resources on a company's balance sheet. A little different when you're running a cryptocurrency or creating a new token, but how do you kind of think about the visionary leaders and the way they're heading it versus kind of the blocking and tackling of how people are getting paid and what the incentives look like?
Yeah, so the interesting thing is a lot of what the conversation just transpired is code. It's written into the smart contracts of some of these protocols, or is controlled when the token launches. So the analog would be something that we look at in every single core report and rating that we do and publish and evaluate. Insider access to tokens, how the token was launched, what is the breakdown between investors and insiders, and team members versus, say, what was made available to the community and what was locked up for long-term governance incentives. So there's this great article that circulates every now and then. It shows a breakdown and pie chart of the most popular tokens and what the distribution was at launch. And so that'd be the comparison. That's the executive comp plan and the team comp plan comparison to equities markets. It's in the form of tokens and in the crypto sphere.
Well, this is always a fun conversation. Huge thanks to Spence Randall from CryptoEQ and Steve Symington here from Seven Investing. You know, this is always fun chatting about everything from compensation plans to what Jack Dorsey is up to CeFi versus DeFi, and of course to the unsustainable yields that some of the cryptocurrency projects are working on. This is your July 2022 collision course between our two companies. We look forward to chatting with you again on August. In the meantime, check out cryptoeq.io for their core reports. Check out 7investing.com for our recommendation reports. We're bringing the best of both worlds from equities and cryptocurrencies to you. In the meantime, we are here to empower you to invest in your future. We are 7 Investing, and we'll see you next month.